Hi, I'm Daniel Oney, Research Director at the Texas Real Estate Research Center. Thank you for joining us for our introduction to our 2026 real estate forecast. You can find the full forecast with commentary on the economic outlook and trends for all of the real estate assets that we track on our website. Today, the goal is to give you some insights into our thinking about these economic conditions and how they factor into the way we do the forecast. To do that, I'm joined by three of the economists who worked on that forecast: Jorge Barro to my right, Yanling Mayer, and Lynn Krebs. Thank you to you all for the work you put in to follow the economy nationally in Texas, locally, and then to boil all that down into a forecast that we hope is really useful for our audiences. We follow economic conditions throughout the year, things like growth, jobs, and interest rates, because those are the things that really influence the supply and demand for real estate assets. George, it's been a busy year in terms of policy and geopolitics. So what has all that meant for economic output and jobs?
Yeah, so it's been an extremely unusual time period. Right now we have very high GDP growth. It's above trend, so trend growth rate is around 1.7 or 1.8, but we have growth now at around 2%. Some estimates indicate that it could go even higher, and at the same time we have almost no job growth. Some estimates indicate that we're very close to zero. It's almost like we've really just never seen this before, where we have very high GDP growth and almost no job growth. And I think to some extent that can be reconciled by things like restrictions on immigration and massive productivity growth from AI. So that made the forecast a little bit of a challenge. In other words, are we going to see sustained GDP growth while we have low job growth? My general sense is that what we're going to see is a little bit of a rebound in jobs. If you look at some of the business sentiment data around the country, a lot of firms are planning to increase hiring in 2026. I think that the tariff shock, the trade war of 2025 made some businesses reluctant to hire and maybe just tried to get more out of the employees that they have. And so I think that as we move forward, we'll have some more clarity on policy, and we could see sort of a normalization in the job market where we see a little bit of a rebound in jobs and maybe a little bit more sustainable GDP growth, maybe a little bit above trend.
Okay. So Lynn, what are you seeing on the growth front?
I agree with a lot of what George says. I think that growth rates in 2026 will be stronger than 2025. I think that deregulation and some of the lower tax policies will help to stimulate demand, but more importantly, I think will help increase output. So I think we can have a stronger GDP growth. I'm on the higher end of estimates, I think. For example, the Fed's dot plot indicates about 1.8% GDP growth for next year. I think that 3% is not out of the range of possibilities. I think we can have that kind of economic growth with increased output such that we can have that while we're still having moderating inflation expectations.
I think that's really interesting. So the two of you have slightly different takes on it. You're heading in the same direction, and that's an important insight for our audiences to get. How do we do this forecast? We're not unanimous all the time, and so we really have to get together as a team and discuss these issues. We look at what other economists are saying, and then we come up with what we think is the best forecast that goes into our real estate asset projections. And so, given that, probably the most important asset that we track is housing. So Yanling, it's clearly cyclical. What's been going on with housing? How has it responded to this macroeconomic situation this year? More importantly, how are we in a correction or even a crash? What do you think?
Yeah, all these are good questions. So the housing market is cyclical, just like the general economy. It goes through business cycles. But one unique feature of the housing cycles is housing cycles the boom and the bust cycles are typically demand driven, or you give it an impetus of demand shocks, then housing market took off. So if we look back nearly 25 years, the 2000s boom and bust cycles was due to initially you have interest rates taken down to very low, and then that stimulated the demand, and it just like the pandemic cycle we've been through. So initially it was the easing of monetary policy and lower interest rate that boosted the housing demand. But once that shock or impetus came to a stop, then the market started to adjust. So that's where we are. A point we're at now, the housing market is shifting. This past summer and spring markets, there's this huge buildup of inventory. So the market is trying to absorb this excess inventory through declining prices. Yes, so the job market being challenging to the housing demand, and 2005 has been a year of softer job creations. And unemployment rate upticked persistently too. So that puts tremendous challenge to households, and the households who are looking to transitioning into home ownership, as well as households who are trying to manage and keep their mortgage payment current from high home prices, high mortgage rates, and ever higher rising costs of living.
So we don't want to give away the details. We want our audience to go and look at the forecast. So you're not foreseeing a crash in the housing market right now?
No, the market is not at a point of crashing. It's tilting. It's in transition. It's shifting. So what made this housing downturn different from the one we experienced in 2000s was, yes, interest rate was a huge factor for the downturn, but if you look at the homeowners, the ones who have a mortgage, nearly 3/4 of them have a mortgage rate below 5%, and with plenty of housing equity. So even if home prices continue to weaken and declines, even in some markets, we do not see homeowners falling into dire distress. So crash is very unlikely scenario.
Well, that's good news. So anybody that follows real estate markets, they pay close attention to interest rates. Lynn, I know that you in particular look at how the expectations for growth have influenced longer term rates. So what's your thinking right now on interest rates?
Well, one thing I've been paying particular attention to over the last year or two is the relationship between deficit spending, federal deficit, and GDP growth. And for over 20 years now, we've been on this trend of increasing deficit spending, especially relative to GDP growth. And so I think that's concerning to the bond market and to the lending in general. I think that, so that's something I'm going to be paying close attention to. If we see, and I do expect to see improvements in that ratio. I do expect, as I said before, to see GDP growth rate improve. And assuming no major increases in deficit spending, we're going to see improvement in that ratio. And I think that's important to the bond market. I think that's another factor. If the lenders become more confident in the labor market, I think that you'll start to see a combination of those factors help to bring down interest rates and bring down spreads that we see in the market. So overall, I think that rates will respond better to the market in these conditions next year than we've seen so far this year.
Okay. So George, as someone who focuses on the macro economy, I've heard you talk a lot about the Federal Reserve. And when most people think about the Fed, they tend to focus on the Fed funds rate, but you've been trying to educate us on the broader Fed toolkit. So how would you recommend we think about the Federal Reserve, and how can we all be better Fed watchers?
Yeah, so when the Federal Reserve makes an announcement on interest rates, it's really making an announcement on short-term interest rates. These are really short-term interest rates on overnight loans between banks and other really short-term assets. But the reality is that it can have an impact on longer-term rates like mortgages or the 10-year Treasury bond yield, but the Federal Reserve also has operations that we call balance sheet operations that directly impact those markets. When we had historically low mortgage rates in the aftermath of the pandemic, it was largely the result of the Federal Reserve buying mass quantities of mortgages. They were buying around $100 billion of mortgages every month. In 2022, the Federal Reserve, as inflation started to rise, the Federal Reserve started to increase short-term rates. And so you might think that because they started to increase short-term rates, that maybe that was the point at which mortgage rates really started to shoot up, and the timing coincided, but it also coincided with the time period in which the Federal Reserve really stopped purchasing mortgages. And as a result, we saw mortgage rates really start to increase, in the back end of 2022 and into 2023. We saw mortgage rates, north of 7%. And so that's largely the result of the Federal Reserve's balance sheet operations, where it stopped purchasing mortgages. But even more than that, it didn't even maintain a constant balance. It started to offload mortgages from its balance sheet. So every time somebody would pay their mortgage payment, they may not know it, but a lot of people are probably paying it actually indirectly to the Federal Reserve. As those payments accrue to the Federal Reserve, that shrinks their holdings of mortgages. And so the private sector has to compensate for that decline in the Fed's balance sheet, plus any new growth in mortgages. That's still going on right now. And so even as the Federal Reserve looks to stabilize its broad balance sheet, it's still continuing to offload mortgages. It's basically just using the revenue that it makes from that to buy Treasury assets instead. And so as we look to the future of mortgage rates, we need to pay close attention to what the Federal Reserve is doing in terms of its balance sheet operations, and not have the automatic expectation that when it changes short-term rates, that it will necessarily change rates on things like long-term bonds or mortgages. And so it's critically important to think separately about the short-term Federal Reserve operations. These are the impacts that it has on short-term rates, and the Fed's long-term sort of balance sheet operations, where it influences long-term rates.
That's a really good reminder. We advise people, don't just pay attention to the headline. You may hear a headline number, some announcement about things like the Fed funds rate. And, George, what you're really saying is that supply and demand, it's determined, they both impact prices. And an interest rate's really the price of money.
That's exactly right. And like you often say, Daniel, you need to think of these as two very different markets. There are short-term markets, markets for short-term assets and markets for long-term assets. And just like, similar but different products, they're interrelated, they can influence one another. But it's really important to think of them, at the end of the day as, maybe somewhat closely related but different markets.
Yeah, no, that's good advice. Well, Yanling, we've talked about probably the most watched interest rate, the mortgage rate. That's really had a big impact on affordability. And what are your thoughts about affordability more broadly in what we've seen this year and maybe what we might hope to see in 2026?
Right, good questions. So really at the center of the market dynamics we are currently seeing is this affordability. Because of a lot of homeowners, especially many first-time home buyers, so mortgage rates is one parameter or one factor that makes buying a home more affordable. But at the same time, you have home prices, right? High home prices is going to offset any lower mortgage rates will afford in terms of lowering this monthly mortgage payment. So with inventory at the level they are today, that's a telltale sign of there's just a lack of affordability or erosion of affordability from high home prices and higher mortgage rates and higher cost of living. So really going forward, yes, lower mortgage rates will certainly help, especially households with low to modest income, because they rely heavily on taking out a loan to be able to buy a home. And lower mortgage rates will allow more to qualify for loans. So that will bring affordability, improve affordability. But one thing I'm watch out for is, well, with mortgage rates coming down, especially if rates coming down a little bit too fast, too sooner, that may reverse the weakening of home price trends. So which means it may send home prices rising again. So that will, to some extent, offset what lower mortgage rates could do for many households that are looking for home ownership. And from the inventory, we are seeing that the highest supply pressure or inventory pressure is from entry-level homes. So at the center, we track closely of inventory by different price tiers, and the low level, the lower priced inventory is just not moving as faster or as much as the higher priced homes.
Yeah, that's a good point. There's not just one Texas real estate market, right? There's local markets and regions and then neighborhood levels. And so I think the thing that I really took away from what you were saying is the fact that we have a big inventory of houses, that's the supply of houses. And that if they're just sitting there, not selling, that implies they're priced too high given the amount that people are willing to pay for them, right? And so something has to give on one end or the other.
Right. Yeah. So lower mortgage rates will, without doubt, help get the market kind of, moving a bit again. But I'm more worried about that it's going to send the prices rising and maybe even add inflationary pressure down the road.
Well, that's something to look out for. Well, it's important that our audiences know that our forecast is not one and done. We do this forecast right at the end of 2025, looking out through 2026. But this team is going to keep tracking all these indicators, and the forecast will be revised if needed. So my final question for the panel is, I'd like each of you to tell me what you're going to be paying attention to. In particular, Lynn, what are you going to track that might make you change your outlook on the economy as we go into next year?
Yeah, it's a great question. We've been monitoring rural land markets across Texas for decades, and we have a forecast model that's been developed based on a lot of different inputs, supply and demand, prices and sales volumes. And the biggest factors outside the market itself, but just sort of macro, is Texas total personal income. And we do expect Texas total personal income to be a little stronger year over year next year than what we're seeing so far this year. And I think that'll be a positive in that we also, the model also considers oil prices and Fed funds rate and our expectations on interest rates as we look forward. So obviously any unexpected changes in those would influence our quarterly forecasting as we remodel that every quarter. But right now, the biggest factor, similar to what Yanling was just saying about housing, is just a huge price run-up that we had from 2020 through 2023. In that 3-year period, the median price of an acre of rural land in Texas increased 52.5%. It's just tremendous. Within the regions, we've already seen a little bit of ebb and flow, a little bit of correction, but then a rebound already. Statewide, we never really had a correction. We just saw a declining growth rate in prices on very low sales volumes. We expect a lot of the same next year. We think that the statewide median price will probably increase 1% to 4%. From the end of this year to the end of next year. We think sales volumes will remain about the same as they are now. But to your question, if we do see some capitulation in prices, as well as maybe some interest rate improvement, although I think that's a distant second to the price level. If we see improvements in those areas, we could see some pickup in sales activity, but right now we're not really expecting that.
Okay, that's a lot to keep track of. Yanling, you focus on housing. So same question to you. What are you going to pay close attention to as we go into and through 2026 that'll really influence your position on the housing market?
Between job market and mortgage rates. If I have to pick one, if I can only keep close track of one, due to my short attention span, that would be the job market conditions. And for maybe two reasons. The primary reason being because the Fed watch closely at the job market, and the job market conditions influence heavily on Fed's decisions on future cuts of interest rate. So that's the first order condition in a way, and the second order condition is because Fed's decision to stabilize or to improve any weakness in the job market affect their quantitative easing, affect their interest rate target, and that's going to have impact on mortgage rates going forward.
That's interesting. Yeah, it's one of those, there's so many moving parts in the economy, so it's sort of like, the leg bone's connected to the knee bone. If something happens over here, it's going to have an impact in this other market. Right?
Exactly.
Well, George, you're responsible for taking the big picture look at the center. Same question to you. What are you going to pay most attention to going in and through 2026?
Yes, I'm going to agree with Yanling. It's all about the jobs. It's such a critical component of the economy and such an early indicator of where we're moving as an economy. Not only does the growth in jobs influence the Federal Reserve's decisions, in particular, like Yanling said, if we see a big bounce in jobs, the Federal Reserve might be more reluctant to reduce interest rates, especially if inflation remains elevated in the months to come. So it influences the Federal Reserve's policy, and it also gives a sense of where real estate markets might be moving. We know that because of a large body of research after the great financial crisis, there's this clear relationship between what's happening in labor markets and what's happening in the housing market. We know that with every job change, there's a change in income. A lot of times, there's a change in geography. And so if we start moving away from this stagnant position that the labor markets have been in for the last several months to a position where there's a lot more churn in labor markets, we could see a pretty significant rebound in across real estate markets.
That's a little bit of an upside, optimistic, hope for employment. Well, thank you three for joining me here to talk about this forecast process. It's really important for our work at the center. It's a milestone each year and something that we can go back and reference to see how is the economy doing and how are these macro factors relating to each of the real estate markets. And thank you for taking time to learn more about our forecast process. If you're curious about the details, I encourage you to read the entire report on our website, where you can learn about the economic components and what we're saying about all of the assets that we track. That's housing, rural land, and commercial.